Among the many things that we need to think about this week is the Bank of Canada's rate decision, which comes down on Wednesday, is widely expected to put in another hike after briefly going on pause. And of course, the catalyst for that will be the hot pace of job growth that we saw from Friday's numbers. And even though unemployment ticked up and wage growth cooled, most people still think it's not enough to keep the Bank of Canada from raising.
70%, two-thirds to 70% of those surveyed believe that a rate hike is inevitable on Wednesday, another quarter point. I always like to say Chair Powell doesn't like to surprise. Mr. Macklem does like to surprise. But this would be the last meeting, and there's no meeting in August. So there is some time for more data to come through. I wouldn't be surprised that he hiked, to be honest with you, but it might be the last one as things start to trickle through. And, you know, it comes back to a lot of a discussion is that a lot of these things are just totally out of his control, whether it's immigration, whether it's international strife and the price of energy, whether it's drought and the price of food. So a lot of things are actually out of his control, but he wants to control, everybody wants to control inflation. So I wouldn't be surprised at a quarter, but I think it's the last one.
And then I guess it's out of his control, and the people that have to pay for the price of it aren't the ones that are contributing necessarily to inflation. When it is those structural factors like immigration, like a supply chain, whatever.
We've had this discussion before. It always seems to me horribly unequal in terms of how these things fall on the population. But, you know, that's kind of not his job. At least I get a sense that Chair Powell always says something like, and I understand that this is a difficult time for the average person. So
does Governor Macklem. Yeah.
Okay. Yeah. So, in any event, you know, the only good thing of it is it will help our dollar, and I'm a Canadian dollar bull. But there still is a pretty big discrepancy between the 10-year here in Canada and the 10-year in the U.S. It's about 50 basis points. We got a lift on Friday with our jobs numbers versus the U.S., which I think was the 15th month in a row with a miss.
No, this one was for the first time in 15 months.
For the first time, yeah, that's exactly right. But we were on the same page.
Yes.
So the Canadian dollar got a bit of a lift. So there's the U.S. 10-year at 402, and the Canadian 10-year is maybe 360, 355. 355?
Yeah, 353, yeah.
Yeah, somewhere in that area. So it's still advantageous to be in the U.S. dollar, but that seems to be shifting, continuing to shift.
I guess the immediate effect is going to be, if we get that another rate hike, is going to be in the housing market. Unless people think, well, this is the last one, so now I can more confidently go out there. There have been some signs of cracks when you look at regionally where things are going. Vancouver moving up, but Toronto pulled back a little bit. So it'll be interesting to see what the effect of yet another rate hike is.
It seems to me that there's just no product. Yes. On the housing side.
And rate hikes can't fix that, as builders tell me all the time.
Exactly. Just another thing to support the price. So there, you know, there is that huge level. I did read over the weekend, interesting, not so much about the Bank of Canada, but I'm just going to throw this out there. People talking about the sharp rise in rates and the continuing hike in stock prices in the U.S. 1987. Were you alive? Sorry.
I was. I wasn't as fully formed as I am now, but I was alive.
Anyways, there's some people that are throwing 1987 out as a comparison for what's going on. I don't buy it, but just for you, if you want to be scared, you can look back at 1987.
We always want to be scared. We get a read of inflation in the U.S. the same day as the Bank of Canada rate decision. We're expecting a pickup month over month, but overall, we are expecting a three handle, 3.1, a almost full percent turn from the prior rating.
I think core expectations are about 5, still coming down big time.
Yes, ex-food energy. Yeah. You know, I like to just look at the headline because that's the way people live.
Exactly. I guess the thing is, and I've been harping on this for 6 months, is the base effects.
Yeah.
So we're still in that. Last year it was awful. This year we're comparing against those very high levels. That sort of continues into July, and things get a little bit more difficult to keep coming to see that number coming down as we progress through the year. But you know, the Fed's going to go in a couple of weeks unless something happens. The balance sheet is going to continue to retrench, both in Canada and the U.S. and globally, really. So the liquidity benefit is less and less. I love that chart.
Yeah, that's a good one. And
that's a good one.
And so it's against this chart that you could plot the S&P 500.
Almost exact. Well, yes.
Kind of, like a long-term version.
So all of the liquidity that got pumped into the system during the banking crisis has now come out, and we're going to continue to see that come down, that number come down.
I would love to get your take on the Chinese numbers in this little moment where it seems like we're looking at possibly a deflationary scenario. Of course, one data point does not mean that that's where you're in, but you are seeing prices come down. Yeah,
and the Chinese don't like big inflation numbers. They don't like big deflation numbers. I don't think they can do enough with monetary policy. And smart people, I'm not that smart on China, but they're looking for fiscal stimulus of some sort. Something, and I listened to someone recently who was talking about the opportunity for the Chinese authorities to do sort of what the American authorities did in 2008, 2009, to support the banking system. So on a fiscal basis. And there are problems with their, I mean, there's...
Like a troubled asset relief type?
That kind of thing. So some people are talking about that. That would be a huge opportunity for Chinese equities as people kind of flock in. Hong Kong's down almost 20% from its February high. And
you probably want to watch these Chinese tech stocks, too, because they're also taking their foot off of the neck of these companies.
Exactly.